बिल्कुल बिल्कुल.
Okay. Good evening, everyone, and welcome to today's Ekatva webinar session. This is Ravi Mundia from Ekatva, and today's topic is investor relationship in startup. It is my pleasure to introduce Mahit Puri, who is a CA and finance professional with 14 plus years of experience in startup advisory, investment banking, capital raising. He works closely with early stage and growth stage startups, helping founders with fundraising strategy, investor readiness, financial modeling, valuation, and pitch preparation. Mahit has supported startups in engaging with angel networks, venture capital funds, family offices, and strategic investors, helping them structure capital raises and scale their business effectively. His experience also includes debt syndication, financial structuring, and M&A advisory, giving founders a strong financial foundation for growth. He has advised clients across sectors, including consumer, food and beverages, healthcare, real estate, and technology led startups in both domestic and international markets, and has also driven business expansion initiatives in Riyadh, Saudi Arabia. Previously, Mahit held leadership roles at Kotak Mahindra Bank, HDFC Bank, and RBSA Advisors, and currently leads startup advisory at Ekatva Consulting Private Limited. Over to you, Mahit.
Yeah, hi Ravi. Thank you for the introduction. You've been kind with your words. Yeah, so I think it's a very interesting topic. This topic is kind of, it goes under the shadow. There is a lot of concentration on, say, pitch decks. How do you make the pitch decks, financial modeling. But I think what really is important in today's day and time is the capital is scarce, and you need to raise the capital. But after that, investor relationships is where we feel that there is a lot of requirement for the founders and the investors to engage together, because that is something which kind of goes under the radar, and sometimes that is the reason why the founder cannot raise the next round, or there is a friction between the founders and the investors which cause problems later. So yeah, happy to be a part of this discussion. Thank you for having me on this podcast, and would love to answer whatever little knowledge I have about my experience of have handling investor relationships for startups, and let's see how it goes from here.
Thanks, Mahit. We have a lot of questions for you. So to start with, what really makes a strong investor relationship beyond just signing the check?
Yeah, uh, a strong investor relationship, I feel, is based on three basic pillars. One is the trust, the second you can say is the transparency, and the third is the alignment of vision. So a check is kind of only the beginning of a startup or a relationship. What sustains the relationship is how a founder communicates, especially when they are not going things are not going as per planned. So investors want to feel as an informed partner, not as a surprise stakeholder. So in my experience, the founders who have succeeded are those who treat the investors the way they treat a co-founder. So, where they share wins, they share the setbacks, and they are basically honest about whenever they and whatever they need help with. The openness is, I think, what converts a transactional relationship into a long-term partnership. For example, I was reading somewhere that during the inception days, Mr. Bhavish Agarwal of Ola, he had, they were burning cash against Uber, but he made it a point to, basically report the setbacks, or their reporting to SoftBank on a very very regular basis, not just the matrices but also the strategy, the hiring, the competitive moves which they were doing. So this deep engagement kind of allowed them to raise follow on rounds even when the unit economics were under pressure. So compared to that, if you go with other founders, maybe in the edtech business, who kind of needed money, but they did not follow a regular interaction with the investors, who are having a lot of difficulty in raising the next round. So yeah, I think this is extremely important. An investor relationship is definitely beyond just signing the check. It's signing the check is just the start of a relationship.
Okay, moving on to the next question. Many founders chase whoever is willing to write a check. Why do you emphasize fit over funds?
Yeah, so basically, it's a kind of an extension of the previous question. So, because a check, there are a lot of people who do write checks, but you need to understand, a founder needs to understand that whether this guy is a real fit for me, because a real good investor kind of opens up the doors for a great network, sector expertise, gets governance discipline. A right investor also has patience during the downturns. The startup journey is not always rosy. You kind of face challenges, setbacks every day. So you need a founder who basically understands your business model and is ready to move with you when the tides are against you. So basically a fit investor understands your stage, your industry, the founder's journey. They know when to push and when to give space, basically. So choosing an investor only because they are willing to fund you quickly is one of the most common and most costly mistakes, I would say, I see in early stage founders. Just going by an example, say Zerodha, they is a textbook case of, say, fit over funds. So both the Kamath brothers famously chose not to raise venture capital at all. And as we see them now, they are performing better than all the VC funded fintechs put together. So they had their own apprehensions, say on long term profitability. They wanted profitability first. They wanted, they had a slow growth philosophy. They wanted to take it one step at a time rather than going or chasing after just revenue numbers. So they did not go for funding in the initial stage. And now we know how well they've progressed. So yeah, predominantly I feel that founders should, take somebody who is a fit for them rather than just concentrating on somebody who gives them the fund first.
All right. How should a founder evaluate whether an investor is actually the right fit?
Yeah, that's, I think, a difficult thing to do for a founder. But what they can basically do, like, the investor does a due diligence on the founder. Likewise, a founder should also do his own little due diligence on the investor. They can basically speak to other founders who have been funded by the same investors to understand how their relationship worked out. So maybe not some as a part of the journey, they can also speak to founders for whose companies didn't work out to be as uh, a success. There are, in the founder's journey, there are a lot of setbacks as well. So maybe the people who had received a setback, they should also be approached by the founder to understand how the investors was responding to them. So basically, look at the typical, the diligence may include looking at the typical check size, the follow on behavior of the investor, their hold periods, and how they behave on boards. Basically also, I try to get access to soft signals, like whether they respond to your emails at time immediately, do they ask tough thoughtful questions, or do they just, are they interested in your business, do they know the product well. So people who kind of answer these questions, or investors who answer these questions, I think would be the best fit for a founder, and the founder should do a little bit of due diligence before signing a term sheet.
Right. You often say investors are strategic assets, not just capital providers. Can you unpack that?
Absolutely. I think a good investor opens doors that otherwise takes you years to reach. For example, customer hires, follow-on investors, regulators, even acquirers. So these basic investors kind of open a lot of doors for you. They're not just capital providers. They bring a, these guys are, the investors are seasoned professionals. They've, funded so many startups in the past. So they understand a pattern. So they bring, a pattern recognition from having seen dozens of companies navigate similar challenges. So I think a founder should basically take advantage of these the big bank of the knowledge bank of the investors. So they should actively use their investors, is what I mean to say. So, basically send them monthly updates with two or three specific asks. You should also start asking the investor that this is the help you need from them, whether it's basically giving an idea about the hiring decisions, advice, take advice on what the pricing strategy should be like. So investors generally want to help. What I've seen from my experience is that all these investors are definitely ready to help if you give them an opportunity and if you ask them. These guys, they don't exactly know what you want. So it is important to have that communication between the founder and the investor and keep asking them for various places where they are stuck. So one example comes to my mind. We've read about Razorpay as a very successful story. So Mr. Harshal Mathur and Shashank Kumar, who basically have given a lot of credit to their initial investors, may it be Sequoia or maybe Y Combinator, for unlocking, the enterprise customers and regulatory introductions, um, which if not for them would have taken years to grow. So basically, you can say a 18-month journey can be cut down to say 18 days if these people, if the investors, they have a lot of data bank and a lot of connections, so they can open a lot of doors. So yeah, this is predominantly what I feel is that they are not just capital providers. You need to ask them questions, and once you ask them questions, they feel kind of included. They want to go on your path, and they would definitely be ready to help with whatever they have, because their their success is also linked to your success. So they are basically partners. You need to take them as co-founders rather than just investors.
Got it. What does a good investor update look like?
Yeah, so I think the first thing is that generally startups do not, at least I've worked in the Middle East also as well as in India. So what the investors often used to, be very in the dark, or very unconfident about, was the regular updates which you need to get from startups. So that, I think, is something which is very important, at least once a month on a predictable day. So, a founder should say that on the 5th of every month, I will give an update on my business to the investors. It doesn't have to be a very long, dialogue or a very long document. It just should have basically four or five important things which any investor would be looking like at. So first would be maybe, matrices versus the targets. So what target you have set and how much have you achieved it. Then maybe a little bit on the wins of the month. So what you've done, what you've achieved in this particular month. It is extremely important to also highlight the challenges and the risks which are associated with the businesses which happened in the last month. So the investors don't want to be surprised at the end of the day, So it is important that, and every startup or whoever it is, they would have their ups and downs. They would have bad months. They would have hit some roadblocks in the particular month. It is important that challenges and the risks need to be highlighted. When an investor sees these things, they would you are giving them a chance to come with a solution to this problem. Also, it is important that you list down a few specific asks. It is important that you write down two or three things which you need from the investor. Maybe you need an introduction to some person, or you need to get something from a regulatory perspective on this. I'm sure, or you kind of need somebody to, just open a different door, or get some advice on pricing strategy, on things like that. So bad numbers, I think investors lose confidence not because of bad numbers, but because of bad surprises. So the dialogue should be on, the challenges and the risks should be highlighted. The wins should also be clearly flagged. And I think you'll be amazed, a founder would be amazed at how much support flows when an investor feels trusted with the truth. So yeah, these are basically the things which are important. I just remember that one founder, I had worked with in the past, had a major enterprise customer whom they were about to lose. So instead of waiting for monthly update, he called the lead investor and the same evening and said that this is basically happening with me. So the investor immediately connected him with some other person, and the relationship was basically saved within 72 hours. So had he, waited 3 weeks for a scheduled update or things like that, it might have, derailed the entire relationship with this customer, which was saved. So yeah, you should give definitely monthly updates with 4 or 5 points, metrics and the wins, the challenges, the specific asks. But if you feel that there is something which the investor can help you with, even in the middle of the month, you should go and knock at his doors.
Right. So even in the bike, if we go right with the bike having brake goes faster, right? So
Yeah,
people
definitely.
have right when the investor knows that whatever go wrong, right, he will get timely update, right? So
Hmm.
definitely he will have more trust. So
For
yeah,
sure, for
moving
sure.
on. Yeah, moving on to the next question. How should founders manage the relationship between funding rounds when there is no immediate fundraising on the horizon?
Yeah, I think this is the most important part. This is, I think, the part where you already raise funds and you don't need funds for the next, say, 1 year or so, but you have a partner on board at the end of the day. An investor is basically as good as a co-founder or a partner. So it is very important that they should be abreast about what is happening with the company between these funding rounds. So, that is where most relationships are actually won or lost. So between rounds is where when investors from their form, they form their conviction about whether they will lead, follow, or pass on your next round. So silence between these rounds is a single biggest kind of red flag for them. So I think you should keep the monthly discussions going on. As I said earlier, you need to give them monthly updates. You should kind of invite these investors to key offsites or product reviews at least once or twice a year whenever you are having them. Share your thoughts about the pieces, thinking pieces about your market. By the time you walk into the next round, your existing investor should already be ready to commit, and the signal basically accelerates new investors too. So they would, if they are aware about what all happened in the past 8 9 months when between the rounds, they would be very keen to come in at the second round on the next round also. Since they are aware about it, they would have, all investors have other network investors as well who are ready to come in at join hands for a good startup. So in that interim period, these guys also help in getting other investors on board. So the basically once you decide to raise, the raising happens immediately. It's kind of an ongoing process rather than a stop gap arrangement. So basically, think of an investor updates like SIP investments. One update is just one data point, but 12 or 9 consistent updates over the year becomes a narrative or a kind of a story of execution, resilience, learning. So when an investor sees, 9 months of consistent, honest reporting, they are it's like a pattern matching you against the best founders they have ever backed. So that track record is what gets you a term sheet within a week when you want to do the next fundraise, rather than wait for 2 3 months before you can actually get a fundraise.
Alright. What are the biggest mistakes founders make in investor relationship?
Yeah, I think the biggest is one is they go silent when things become difficult. So there are, as I said, there are more challenges and losses in a founder's journey than the highs. So you know when the trust destroys faster, when so basically, if you basically go silent when things are not going right, this destroys the trust faster than the bad news itself. Second, I think, is over promising in pitches. Everybody, I've seen founders say that we'll achieve, are generally optimistic, but sometimes they commit beyond the optimistic scenario also. They say, okay, we'll achieve X, Y, Z. But what happens is that when you're not able to achieve that, it is they just investors just get put off. If it happens quarter on quarter, they are not interested in the next round. So it is always good, and I always tell my clients to commit to a certain extent, commit less, and try and over deliver that. So if you are over deliver, the entire narrative changes. Also, one biggest mistake which founders make is that they treat governance as a formality. It is ideally, I would say, the most important part of the journey. So board meetings should be substantive. The details of it should be sent in advance. People should be well prepared, should genuinely seek up inputs, just not to report. So founders who basically treat governance and board meetings as very important, they generally tick the boxes when it comes to managing the relationship with the investors. So yeah, so this is basically, in 2022-23, there were a lot of startups in the edtechs or the companies which failed. They all, shared a common pattern when it came to postmortem of these businesses, was that the founders started or stopped sending any updates when the metrics started slipping, board meetings were not happening. So, and difficult decisions basically got pushed to say the next quarter and quarter. So it kind of derailed the entire process. And this was one of the regular patterns which were seen in companies which did not survive. So, and these companies had a good cap table. They had strong investors on board. But this thing basically, this was one of the mistakes which when these people, the founders went silent during difficult times, that was a big reason for the failure of these companies. Yeah.
Right. How should a founder handle disagreement with investors, for example, on strategy or hiring?
So, when there are two people on board and they are chasing the similar type of objective, everybody has a different perspective. आज हम घर पे भी बैठते हैं, so if we are 5 or 6 members at home, everybody is entitled to their view, and they all have different agreements, disagreements on particular points. The idea disagreements, ideally, I would say, are healthy as well as inevitable. The key is to disagree on, say, substance and not on tone. So that is, I think, something which I always tell my founders and even my partners. We've kind of come to a consensus that we should disagree, but on substance, and it shouldn't go on the other way. So if you have a disagreement, if you have a view, a founder has a view, he should come prepared with data, articulate their reasoning, acknowledge that the investors concerns are explicit, and they are actually concerns, and basically address them. So one thing a founder needs to remember is that he runs a company day to day, but an investor also has fiduciary responsibility towards their own limited partners. So they come from a different space, and it is important that their concerns and their interests are also protected. So if you understand their constraints, you can also give a founder can give a far more productive reasoning, and a conversation can happen better. And sometimes investors can be genuinely right. Staying open to the possibilities of new ideas or ideas from investors is what separates a great founder from a defensive one. So I would basically, I recommend a 3 document approach when there is a disagreement. One is that a 1 page memo, summarizing the decisions and the alternatives which you are suggesting. The second is data and assumptions behind your recommendations. And basically, you need to say, okay, what can change my mind, or, how can we solve this disagreement between us? Once you give this, and it kind of looks like a more collaborative kind of discussion rather than the founder just being coming up as stubborn. So that is, I think, that is what is important in a founder and a investors relation when it comes to handling disagreements.
Got it. Investor confidence is a key theme of this webinar. What signals build it and what signals destroy it?
So I think there is no way confidence can come overnight. It is a very long, lengthy process. What we discussed some time back that, in the 9 months, once you get a check to when the second check comes, that is the point when the confidence of an investor excels. So confidence is, built very quietly over many small interactions. It is built when you kind of hit a target that you set. You had given a target and you hit that target. When your team grows in caliber, when your customer testimonials get stronger, when you demonstrate financial discipline. So none of them are, flash in the pan. But it is a consistent story which kind of grows slowly over time. However, on the other hand, if you see the flip side of it, confidence is basically destroyed by inconsistency. Say you commit a number and then the number changes. You talk about a number on the phone, but when actually the paper comes, the number is completely different. Then there are key people who leave the organization or without warning. Governance lapses. This is basically what basically puts off a investor. So basically investors, I would say, are basically pattern matchers. One inconsistency they will overlook, but say three or four inconsistencies in a row, they will start questioning the entire story. So you don't want an investor to question your story. You want yourself to be coming across to him as an honest businessman, and basically be open about whatever you are facing with him. So I remember, when the Nika IPO came out, the team was known for impeccable, financial discipline, consistent communication, quarterly numbers that reconciled kind of perfectly, governance practice that matched with listed companies. So it was easier for them to kind of get confidence of the investors, and this basically translated into great good issue filling at that point of time, as compared to say other founders who we've seen in the recent past have lost out because not because they did not have great companies, but they had governance issues. So I think governance and is something which is extremely important. If the investor kind of has a problem with your uh, with a trust, it kind of derails everything. Everything can be taken care of, but trust, once it is lost from the investor's point of view, then it is very difficult to kind of regain that.
So we are coming to the last question. If you had to leave founders with one piece of advice on investor relationship, what would it be?
So I think what it would be that treat your cap table as a long-term marriage and not just a short-term transaction. So every investor you bring on board will influence your next 10 years. So your governance, your culture, your strategic choices, and ultimately your exits. So a founder should carefully choose an investor carefully, communicate consistently, and remember that investor funds conviction and not just ideas. So if you walk into every room, board meeting, pitch meeting, update call, clear about where you are going and honest about where you stand, the right investor would definitely back you. In fact, he will champion you and he'll open so many doors for you where you would have taken so much of more time to reach. They will open these doors for you. So yeah, I think this is one piece of advice which I would always give founders, that keep a very trustworthy relationship with your investor. Give them what data which backs your things. Give them the hard news also. Don't hide it from them so that it comes out one single day that everything, all hell's break loose. And you'll see the difference. These guys are also, they are linked with your success, and they would want your success, the success to happen. But so that is, I think, what is to be taken care of.
All right. Thank you so much. So the forum is open for questions for audience. If we have any question from audience. All right. Thank you so much, Mahit, for the insightful sessions. And thanks to the audience for the active participation. Thanks, everyone.
Thank you, Ravi. It's been a pleasure, and always a pleasure to have such discussions with you. And looking forward to various such discussions in the coming future.
Thank you.
Thank you. Bye bye.
Bye bye.